The European Commission unveils its new plan to make big companies pay their fair share of taxes and tackle corporate tax avoidance. The action plan includes a new push for a common consolidated corporate tax base and also a public consultation on tax transparency. The European Commission unveiled a so-called action plan to relaunch the common consolidated corporate tax base. This plan, first proposed in 2011, includes one single European system that cross-border companies could use to calculate their taxable incomes in the EU, instead of having to deal with 28 different national systems. The same rules for calculation will also be applied for all member states. However, the consolidation of rules, which means the same taxation rules for each company, has been the most difficult point in negotiations with the EU member states so far. Several countries, like Ireland, fear about losing their sovereignty in the fiscal area. As the European tax proposals require the approval by all EU member states to take effect, the European Commission proposed a two-step approach by analyzing the concerns of each country first to create a consensus. But in any case, the European Commission explained that the idea is not to set up a unique corporate tax rate which would be hardly accepted by all the country members.
Nous avons décomposé cette action en deux phases. D'abord une assiette commune, puis ensuite nous reviendrons à la conciliation. Mais attention, l'assiette commune doit être obligatoire. C'est tout simplement définir ce qu'est la base taxable. À partir de là, on fixe les taux. Il ne s'agit pas, de notre point de vue, je le répète, d'harmoniser les taux. Ce n'est pas ça qui est en cause, mais d'avoir une assiette commune qui est au fond le prolongement du marché unique.
The European Commission explained that finding an agreement will last at least 18 months. However, for Molly Scott Cato, a Green member of the European Parliament, the Commission is wasting time, especially as the technical work is already done.
It's too late, and it's hard to believe the Commission means it because they've launched it before. They seem to launch it more as a concern for public opinion than really meaning it. So we're challenging them to really mean it, to make sure it is a common tax base and it is consolidated, and that they really push forward on that as quickly as possible.
The action plan also includes a public consultation of tax transparency. During 3 months, the European Commission will gather feedback on whether companies should publish certain information about their tax scheme and their annual profits. The so-called country-by-country tax reporting aims to get rid of loopholes. Pierre Moscovici stressed that first an impact assessment is needed to avoid discouraging the business. But he clearly explained that he thinks a reporting country by country is necessary.
Nous lançons aujourd'hui d'abord une étude d'impact pour voir quel résultat aurait le country by country reporting sur l'activité des entreprises et aussi une consultation publique dans laquelle chacun pourra s'exprimer. Au terme de la consultation publique, nous prendrons notre décision, mais je le redis, pour moi, cette décision doit être positive. Il ne s'agit pas de savoir si nous allons faire le country by country reporting, mais quand et comment, et sur quelles données, avec quels résultats.
But Molly Scott Cato sees things differently. The British lawmaker believes the impact assessment is just a way to gain time.
They've gone back on their word again here because originally we were going to have country-by-country reporting. Now they're saying all they're going to do is an impact assessment. And, you know, I mean, that's not the point. If this is right politically, we should just make it happen. We don't have to wait to see the impact. They're avoiding the country-by-country reporting because they're afraid of having to pay more tax, in my view.
Corporate taxes have been recently highlighted, showing tax arrangement of big multinationals as they can legally reduce their bills by basing themselves in low-tax countries such as Apple in Ireland or Starbucks in the Netherlands.